leading the way on that front, outpacing many other traditional players. Thank you very much for giving us that story, Lynn. Chidu Narayanan is head of macro strategy APAC at Wells Fargo Securities, joins us right here around the desk. It's a packed house in the studio. Chidu, lovely to have you on the show. Thank you very much for your time. So Lynn, of course, highlighted the focus on new tech. From a macroeconomic standpoint, what does that mean for the Chinese economy?
Good morning. Thanks for having me over. On China, that's the transition that they've been looking at for a while. They've been looking to transition up the value chain. They've been looking to transition away from the low value-added goods to the higher value-added goods, both primarily on the electronics front. And that's a transition that's been a few years in the making already and will be a few years in the making going forward. And second transition that they're looking at is also moving on to a more consumer-led economy, driven more by domestic consumption. But that's still some time down the line. Near term, we still think that there is a bit more weakness on the Chinese yuan that you can be seeing. On the other hand, the FX being a relative value play, you might not really see the highs that we saw or break the highs that we saw last year, because we do expect that the dollar will be slightly weaker through the year. The trend for a depreciating dollar is going to be there this year for sure, we think. And there might be some, it might not be a straight line depreciation, there might be some spike up in the dollars, particularly around late Q1, early Q2, but I think that's the trend for the year this year.
But just scratching that point on China changing its economic model and, looking at higher value goods exports, also at a time when largely the currency weakness has been favorable for China. I mean, I know you say at 7.5, it's compellingly weak, but at 7.15, it's also a weaker currency, right, which supports their export demand. How are you looking at the new model structure help growth in China, help the ailing economy where domestically things are not picking up, especially on the consumer front, confidence continues to remain low? And the RRR cuts, I don't know, like we've seen a series of them, about 15, 20 of them. RRR has come down from 15% in 2019 to now 7.5% or below. So, how much of that from a policy measure is really helping?
Right. So two parts to that. One, on the FX, I think it's more instructive to read it not just against the dollar, but against trade-weighted basket, which is how the policymakers look at it. And on the trade-weighted basket, in fact, there is even more chance for the CNY to be weakening. We think this year, especially as the broader dollar complex will be weakening, policymakers might take the opportunity to weaken the renminbi against its trade-weighted basket, while not letting it weaken too much against the dollar because the dollar is weakening. So that's the way we think it'll be transitioning this year. And yeah, like I said, it's going to be a slow move for growth to really pick up steam in China. Particularly, you hit the nail on the head talking about consumption, and that is the big factor. And consumption is driven very heavily by sentiment as well, and sentiment is right now quite soft.
So 4% or sub 4% is your expectation?
We think thereabouts, maybe slightly higher. The focus, though, will be near-term for markets on the FX itself. And this year, the focus will be on the other side of the FX, because last year you had this massive momentum driven by the dollars. And policymakers across the region, not just in China, had to face the brunt of a much stronger dollar, which meant that their FX was breaking down to new lows. That pressure will be off for this year, so that should give a little bit more breathing space.
Got it.
You'd want to hope that when they keep cutting the RRR that they don't have a banking crisis brewing underneath the hood. But just in terms of the dollar, because what we're seeing right now is there's been I suppose, a heightening of short positioning coming through for the USD. But how certain are we that that's a trend that's going to continue? Because, there's this complete, I suppose, yawning gap between what the markets are believing the Fed's going to do, what the Fed is saying they're going to do. You've got now the talk of tapering QT, cessating it completely by the end of the year. So if we just go by what the Fed has pretty much suggested and clear out all of the market pricing noise, which is usually more correct, but let's just leave it at that. But say we get the higher for longer, say we get maybe like at best what Bostic was saying in terms of 2 Fed cuts and pretty much no talk as of yet about ameliorating QT, does the dollar still weaken significantly in your mind? So
that's a very good question. And the dollar weakness story is something that markets have been thinking about for 18 months now, and they've been disappointed for 18 months now. So the reason why we think that this year might see that dollar depreciation is because the Fed has shown its hand at the December meeting. They've shown that they're looking at cuts this year. Whether the question of when it comes, how much comes is separate, and for the broader trend of dollar weakness doesn't really matter as much. If the Fed's cutting, if the Fed's looking to cut and looking to start cutting, markets are going to extrapolate that and look to see where it'll go.
The broader point I was trying to make is, are we certain that the market and the US dollar weakness that we are seeing right now isn't then predicated on the market pricing of the expectations of the Fed? And if that doesn't come to pass, should we then not expect a flip around?
Absolutely, absolutely. I think that's the way we look at the dollar near term. So near term, we think that looking for the Fed to be cutting as early as March or April is a little bit over optimistic, and we're looking to fade that pricing on the rates front. It doesn't translate as well to FX, so that's clearly more a better expression on the rates. In terms of whether that sustained dollar strength, whether that dollar strength could be sustainable, it depends on a couple of factors. One is the economic backdrop and growth story. Is that completely collapsing, and is there a deep recession? In that scenario, you would have dollar being even stronger, even if the Fed has to cut rates because of risk aversion and so on. But on the other hand, if growth tends to be reasonably steady, and you're talking about a Goldilocks sort of scenario where the Fed doesn't need to be cutting as dramatically because growth is very steady and inflation is coming down as well, then risk assets perform really well, in which case the dollar will be softening as well, because you don't have the same dollar outperformance or US economy outperformance that you've had for the last, say, 2 years.
Just go ahead. I was just going to say, just really quickly, because this sort of would then play into your thesis that we are going to see perhaps the yen at around about that 138 mark. But that opens up a different kettle of fish, because, you know, what kind of expectation when it comes to BOJ policy are you predicating on that? Because, you know, there was this growing consensus, oh, December's going to be when they move, and now it's like, oh, it's going to happen in the first quarter, or potentially around the Shunto wage negotiations. But, you know, you look at all of the incremental data that we've been getting. If we're looking at the Tokyo CPI as a leader, and let's not worry about fresh food energy, let's worry about, you know, some of the more core prints and some of the internals. You look at the wage data that we even got through today, all of that suggests that no matter how much they've been injecting into this economy and the prospect of even more with the extra stimulus packages, that it's not having a significant inflationary effect in the way in which that they wanted. So does that not open the door for continuation of this easing path, at least to the back end of 2024, and in turn, what that would then mean for the weakness playing through for the yen?
Absolutely. So one, on the yen weakness or the yen strength that we're looking for, it's predicated less on what happens in Japan itself and more happens on what happens in the broader global economy. Just talking about Japan for an instant before turning around to what happens on the dollar. One, yes, we don't think that the BOJ is going to be aggressively normalizing policy yet. We think maybe Q2, possibly even early Q3 would be the time that they will be looking at normalizing policy. They've been looking for inflation for multiple decades now.
Really quickly, just on that. If the Fed does go as hard as the market says they do in terms of them cutting rates, does the BOJ then have a little bit more wiggle room and not have to get more aggressive in hiking their policy?
I think the BOJ is focused more on domestic inflation and how sticky that inflation is and wage pressures. So they're looking at both inflation getting up to where they want it to be and being sustainably so. A spike in inflation doesn't really support them, and a sustainably lower inflation, if the wage picture doesn't fall into place, doesn't really support them. So they'll be looking more at what happens domestically on a rate hike when they talk about it. But on the yen, given that it's predicated less on the domestic economy, it actually plays well in both scenarios that's possible on the dollar side. If broader global economy slowdown happens more dramatically than we currently think, that's going to be risk aversion and positive for the yen. And if you have a soft landing scenario, that mostly what markets are expecting, say close to December, even right now, that again is a broader dollar weakness, which plays into a dollar yen lower as well.
I'm sure we'll talk about that soft landing scenario when we come back from the break and the potential implications there.